everyone, and welcome to another episode of Impact with Elle. I'm really glad that you've joined me. I'm so excited to see we're getting more subscribers. I look forward to more dialogue. I'm hoping in the future I can have guests join me and we can actually have a back and forth. I'm not interested in having the same side or one side. I definitely want to create a forum for a real discussion. So that said, today I want to talk to you about mortgages. I think most of you know I am a realtor, and so it's something that I deal with on a regular basis. But aside from that, I think I'm a financially savvy person, and as such, I think right now mortgages and real estate are a great place to be putting money. And there's basic economic reasons for that, some of which I've touched on in various episodes. But today I want to highlight an example. So I'm going to be looking at some notes because I have some numbers here. So, bear with me on that. But, looking at mortgages and the tendency for people to say, oh, I don't want to do a mortgage. I don't want to have debt. Or I want to pay it off as quick as I can. This is normal. And I think it's a great internal sentiment, but most of the time, it's actually not a good financial decision. Having a mortgage is an excellent thing to have right now. Debt is becoming an asset, which really is kind of confusing for a lot of people. But at the current interest rates, and even in interest rates in the past, as compared to inflation, it makes a ton of sense. So I'll walk you through my example. So imagine 30 years ago, well, let's say 1976. You got a mortgage, a 30-year fixed rate mortgage. At that time, rates were 7.3%. Probably hard for a lot of us to imagine because one, if you're old enough to have gotten a mortgage back then, you probably forgot about those rates. But also most people, who are viewing this probably didn't look at rates back then. So 1976, 7.3%. So if you took out a $14,000 mortgage, which would have been reasonable, mid-sized house in a lot of areas, that monthly payment would have been $101. Okay, so you would have repaid $36,000 on the face of it. At least that's what people would have thought over 30 years, including the interest payments. But that's kind of a false way of looking at it. Basically, if you think about it, a dollar then is 30 years later, given inflation, worth 24 cents. So again, this is a math problem I went through. Everybody can do it if you want to take the time. Most people don't. It's kind of boring. But a dollar became 24 cents 30 years later. So the dollar amount on your mortgage per month stays the same. It's your 101 monthly payment. But the real amount is only $24. So people, rarely think about it that way, but it's a pretty huge difference. So what you actually repaid was the $16,393 after inflation ate it all up. So your effective interest rate was 1.06%, not 7.3. Again, your effective interest takes into account inflation. So your after-tax benefits, which would include the mortgage tax deduction, which I think those of us who own property are familiar with, would actually have given you a negative interest rate. Your negative rate would be minus 1.16% interest. So people were actually being paid to live in the house. I mean, it's a phenomenal deal. Right now, we're looking at the same thing. If you can get a 30-year fixed rate mortgage, around 3% is where a lot of mortgages, 3 to 4% is where they're landing right now. That's incredible. And I think it is an asset. So I encourage you guys to work through the math yourself, take into consideration interest, and think you could be paid to live in your house. So I encourage you guys to broaden your horizons on this, look into it, dig into it. If you want to ask questions, have a dialogue, please leave comments. I very much welcome them. So I hope everybody will like my episodes and subscribe.